The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks, and I'm certainly going to be talking about the Bradley model in the stock market. I'm going to stall that as long as I can. Well, not really, but I had a couple of questions that people asked me to address today on the show, and one is I've mentioned several times in some of my books about using a 4-minute chart, for trading some of these things, and that's basically because the Earth rotates 1 degree every 4 minutes, and if you're doing some really sophisticated astrological things, for timing, that four degrees might help. But frankly, a 5-minute chart is just fine. It'll give you all the swings that you need to look at, and basically I look at hourly, 30-minute, 15-minute, and I go down to 5-minute. When I'm looking at the charts. If you have any questions, it's 877-927-6648. The other question that someone asked me to cover is that, I've been trading, since 1959, and the person asked me what was the best trade that I ever had. And I thought about it for a little bit, and then I realized that the best trade that I ever did didn't have anything to do with money. And I'm going to post that into the Tiger TV today and show you the chart that I'm talking about. It's a chart of AIG, and I was flying on a plane from from Hong Kong to Narita. I had just given 3 speeches for the Chicago Board of Trade in China. I stopped off in Hong Kong to visit a couple of students and friends, and I was on my way from Hong Kong back to the United States through Narita, Japan, which is a suburb of Tokyo. And in front of me on the plane was a young lady, and she asked me to help her with her bag, and so I did. And she was rather sad because her mother was dying, and I said, why don't you join me in the lounge? And so we went into the lounge, and I proceeded to put the full court press on to try to impress her. And so what I did was I found out that she worked for AIG, and she was in AIG stock. She said she had quite a bit of it. And so I looked at the chart, and I saw that it was at a major sell signal at $72.50. And so she sold the stock right there in the lounge at United Airlines, and she sold it at $72.50. And the stock eventually went to 18 cents a share. Well, that turned out to be my wife. Sarah was the one that was on the plane, and so I think that's probably the best trade that I ever did. It didn't have anything to do with the monetary part of it, but the other part of it was really, really quite good. And she's actually a very good trader now herself. So she's it's one of the things that when you do these things, little benefits, you don't really know the perks that we have. That is, really, really nice. Now, the other story that I wanted to talk about before we get into the Bradley model and the other stuff, and this will be related to that, is back in 1983 when I was down on the floor of the exchange at the Merc. One of my good friends there was Byron Tucker. Byron and I are still very, very close friends. He's involved with hedge funds, and his wife is involved with funds of funds. She has several $1 billion that they trade in New York, and they live also in Connecticut and part of the time in Scottsdale. But what happened that day was Byron was running he was a floor manager for Goldman Sachs at the CME. I met him the very first day that I got there. He's not a sports enthusiast, but he had a client come in from Germany that wanted to see the Chicago Cubs play. And if you've ever been to Chicago, you'll know that the Cubs is part of the subculture of Chicago. I mean, it's like nothing else you've ever seen. So he took the gentleman from Germany, and they went to the game. And at the top of the 9th inning, the team, I believe it was the Cincinnati Reds, were ahead 9-0. And you can't leave Wrigley Field because there's no parking, so everybody just parks on the street. They block all the cars, and then when the game is over, everybody leaves. So the stadium is still filled. Well, Byron, not knowing this, he's at the game and he's bored stiff. How are they going to come back from 9-0? And the German guy had never been to a baseball game before, so he thought it was rather exciting. So it's 9-0 in the top of the ninth. The Cubs come up in the bottom of the ninth. They score 10 runs to win the game by 1 run. That never happened in all the history of Wrigley Field, which is the second oldest ballpark in the United States, right behind Fenway Park. So he calls me up and he says, it's 9-0. He said, what am I going to do? I said, you can't do anything. I said, you can't leave. I said, because all the cars are blocked. Just sit there till the game is over. And sure enough, the Cubs scored 10 runs and won the game. It ended up being a very big event because the Cubs have never won a championship since the 30s. So this is how I felt on Thursday, folks. The S&P had closed down 30 points from where we had sold it at that 1385 level. It was trading around 1355, and I said, I think the Bradley model has finally got this one right. And the next day, whatever the reason, jobs report or whatever it happens to be, the market rallies really strongly. Now, when I wrote the letter, 2 weeks ago, a week ago last Monday, I said that you have to have a time band here to August the 10th. And the reason for that is the Bradley model, however good it is, sometimes will have a 5-day band on it, and that band exceeds to Wednesday. So if we're above 1,400, is what I talked about, when we've done this show sometime, and also 13,200 in the Dow, and believe me, we are very close to that. That's 13,160 right now. This is what we're looking at. So we have a little band here of how the market should possibly move. I picked the 10th because if you go back and look at some of the other tops in the Bradley, that sometimes they will be off by as much as a week or more. And overall, it should be okay. Now, if I'm wrong, this market's going to explode above 13,300 in the Dow, and it's going to get above 1,400 in the E-mini S&P, and I'm flat going to be wrong, and I'll just stand aside. I think I know the reason why we would be wrong, and I'll share that with you in a little bit. But that's the way it looks right now. Now, if we go and take a look at some of the other things that we're looking at, and one of the things that we want to watch is the New York Stock Exchange Index, and I want to be able to see how that is working because, we are completing a beautiful pattern up here in the New York Stock Exchange Index, and what we'll do is we will have a spot here where we'll be able to see a head and shoulders pattern that is occurring, and you'll be able to, see that we are right at the spot right now where we could be, making that final completion and what we will be looking at over the next few days. Now, the other markets that we watch, of course, the small caps for the Russell is extremely bearish. It really has a situation where you're having lower tops and lower bottoms, and so that has a very, very bearish tone to it. I will post that. I'm trying to find it. I've got these things stacked up, and I've got too many charts today probably. So what I'm going to do is before I'll get this ready for the break, is that we have I want to do the VIX index because we're at a very critical point on the VIX index. We've had these ABCD formations forming down here. The market is very complacent, and you'll see that the VIX index it hasn't even taken out yesterday's low yet, which really surprises me. So we want to just with one eye on it, keep an eye on the VIX index. It's very difficult to trade, but it does have an idea of tops or bottoms. Now, if we're really wrong here and the Bradley model, then we have to think that there's something that is causing this movement that is going to be affecting all of us for a long period of time. And what I think that could be, if I'm wrong, and I've got to give it a few more days, and really what's happening with the market here is really nothing, dramatic. It's, had this big day Friday, but, remember what Thomas Jefferson said, any country that can give you everything you want has the ability to take away everything you have. And that's the same thing with the market. Anytime the market can give you everything you want, it has the ability to take away everything you have. So you don't really know. But here's where I think, if I'm wrong and the Bradley model is wrong, it's going to be in the U.S. dollar. And I'm going to put in the dollar index here for the weekly basis, and you'll see that we've rallied up to a 61% retracement, which is a Gartley sell pattern. We've been rallying since last May, so we have gone through one solid little more than a year, about 14 months now, where the dollar has been rallying, and so we could be in for a real horrendous correction in the U.S. dollar. And when you stop and think that everybody in the whole world is bearish the euro, including myself, I really believe the euro is going to go to 115 or even lower, but we could have a tremendous rally in the euro. And we mentioned this before, is the fact that we could easily make the 126, and we already hit 124.50 today, and so we're well on our way to be making an AB equals CD in the euro up into that 126 level, which means the dollar index still has more to go to the downside. On the daily U.S. dollar index, we highlighted that many times with the ABC formation that was there, and the fact that it had made those three tops and then made the butterfly pattern. And this is what we're looking at here on a shorter term basis. And as long as the U.S. dollar doesn't go below 81, it still has a potential to rally. But if this market does go up, and I'm not saying that it is, but if it does, it would probably be due to what's happening with the U.S. dollar. And I'm just technically, I don't understand the fundamentals, never have, don't even want to know. So I'm just looking at the technical part of it. That's what we're looking at. Now, the same token, we have to be looking at the bonds. We'll cover the bonds in the second part of the show, but I wanted to get in and just give an idea of some of the things that we are watching. Now, the full moons that we've been watching, we topped, we believe, on that aspect of the perigee. Then we had the huge break in the market from Monday through Thursday. And on Thursday, we made a 61% retracement of the cash S&P from the low that we made, back in late July. We rallied up into the August 1st, and we came down into the full moon on Thursday, which was the exact date, and then we rallied up, and then we've taken out the highs of that other day. Now, whether we continue to go up or not is going to be very important, because we must accelerate from this level. Otherwise, this is known as a false breakout, and then we'll see it. The reason why I think it's a false breakout is the fact that I think the Bradley model deserves, a few days on either side of this spot to take a look at it. I know it looks so good Monday, Tuesday, Wednesday, and Thursday, and believe me, if you want to talk about frustration, I had a frustrating day on Friday. Didn't lose a lot of money. Well, didn't lose anything, but it was not a very fun day to watch the market go straight up. Okay, 877-927-6648.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and we're continuing with the stock market. We've covered the S&P, the hourly. We've covered the Dow Jones, and now we want to cover the NASDAQ. And as you can see, we have completed the 786 retracement up here. Today is where we're trading right now. That's why if we could get a really strong day today and we get above these levels of 13,200, in that area of the Dow, and above 1,400 in the S&P futures, I'll have to say that the Bradley model is off, but it's basically a time stop. So. We'll see. I'll get back in it if it does get above that spot, but that's really what we're trying to look at here, and we will do one thing at a time. Now, the next one we want to look at, of course, is the Russell 2000, which had been the leader, most of the way up until March. Then it had the sell-off, and now we've had lower tops, and we have not even taken out the high of the late July, let alone the high of early July, and the others have already exploded, above those levels, and so it doesn't look like a true bull market, in my opinion, just based on the divergences that we're seeing. And if we take a look at the transportation index, which is one of the things that we watch when we're looking at all these things, you'll see that the transportation index is still seeing these series of lower highs, and hold on just one second. I have a mental challenge here with my charts. Oh, dear. I hate it when it does this. Hold on just a second, folks. I'm trying to get everything to fit on the page, and as I talk, there we go. I think we can see it now. You'll see that if you go into Tiger TV, you'll see that you'll have a declining tops, all along the Dow Jones Transportation, going back several months. This is different than what the rest of the markets are doing. And so that's another reason to take a look at it. The other one to look at that we watch, which is all part of the Dow theory, is the utility index, and it has all the earmarks, of a major top with the butterfly pattern and the three drive pattern that's occurred at that level, and the utility index is actually not even up on the day-to-day. So this is going to be a real critical level the next couple of days in here. I know we'd like to have the full moons and new moons hit exactly on the spot. Something happened between the perigee of the moon on last Monday. The market went straight down into the full moon and stopped at the 61% retracement. I was a little nervous when I saw that. And I said, wow, if you have to pick a spot to take some profits, this would be the spot, because if it gaps down the next day, you'll have a home run, and if it doesn't, you're going to be able to sell it on a rally. But I was not expecting the rally to be, 250 Dow points in a matter of a few minutes. And those reports, folks, I know that they have numbers in them that not many people understand, and they change those numbers, every month, when they revise them. So it's basically how people are perceiving what these things are doing. So that's the reason we're looking at this. Now, we're also having a pretty good rally in Hong Kong. Hong Kong is completing a big AB equals CD pattern right near the 61% retracement. So we have to take a look at that. And but there is a real strong possibility here that my analysis of the market going down could be, off by, a considerable amount, and you can't stand in front of it. I certainly can't buy it here because I think it's incredibly overbought, but I will wait and to see, what's happening here in the next day or two, because they do have a, tendency to, to turn on a dime on the upside, just like they did, turning on the downside. So those are the things that we're looking at. Now, someone asked me a question, about the dollar index and how it relates to all of this, and it's basically the dollar is really the currency of the world, because the euro versus the dollar is the most active of all, and everybody, even though they complain a lot about the U.S. dollar, that's where they come to when things get really, really interesting. So if the market does have a big move to the upside, it could be related to the fact that we are in a spot where the U.S. dollar, could actually, start to fall farther than, what we originally thought. Do you remember, when we were talking about the top in the U.S. dollar at 84, we said that the first place for it to come to for support would be, this 80, just under 82, and we're very close. We'll cover that, after the break. We will go into the U.S. dollar more in depth.
Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and I wanted to move over to the gold market. We've had another move up in gold today. This is the one that we talked about a few weeks ago. We've made our 4 higher bottoms now in the gold market. Each one has been higher, coming off of that 1522 Fibonacci level, which was the 618 on the yearly chart, going back to last July, or monthly chart, weekly chart, whatever you want to look at. But that held, and now we've had 4 higher bottoms. All we really need now is for gold to clear above this last 786 at the 1635 level. If we can get it to close above there, and that's only $20 from where it's trading right now, I think we've got a chance for gold to move. And once we do that, that would be equivalent to about $29 in the silver. But, silver is much more thinly traded than gold. It's about 1/5 the amount of traders. So if we can get above that 1635 level in the gold, that sets up, a whole new ball game, in my opinion. But, we are moving higher. The gold stocks that we looked at last week are starting to work. Whether that's related to the rest of the market going up or not, I don't really care, because I think they can go up with the rest of the market going down. So this is one of the things that is working well. So as long as we can stay above these prices in gold, we are in an uptrend, because you've had higher bottoms and higher tops, and this is how the market defines the trend. And this is this is what we're looking at in gold. And it does look like it wants to, wants to move higher. We're having the same situation in crude oil. I'll cover that just a little bit later, but crude oil certainly looks like it wants to go to that $95 to $97 a barrel level, which is not very much. When crude oil can move 5% in one day, folks, like it did on Friday from 87 to 92, it can move from 92 to 97 that quickly. So just remember that these markets are very volatile. They're fun to trade. They follow the numbers really good. But once these trends start up, you don't want to try to stay out of the way the best you can. Now someone asked a question about the euro on a shorter term basis because of the wild fluctuations that we had on the euro on Friday, and I believe that the euro has some really nice patterns that are forming now. I mean, they're very they're quite easy to see, I believe, on a shorter term basis. What I'm going to do is I'm going to blow up the chart of the euro and show you what's happened over the past month, because we have a very nice AB equals CD forming. What's interesting about this is that on Friday, we had the market go up 270 points. That was following the market coming down 270 points on Thursday. And there again is one of those situations where what the market can give you, the market can take away. So we do have a Gartley pattern forming at the 124.75 level. That is nothing more than a rally in the bear market. The way that it looks right now, it would be a perfect Gartley pattern coming in at 124.75, and I would be looking at that point for the market to have a good sell-off. Now, if we clear the 125 level, and if we clear 126, then it's a whole new ball game. But right now, it looks like in the next day or two, we should make this level of where we are. And if it's related to stocks, which it could be, this could be the reason if stocks, begin to sell off, which is what me. I'm the one that's expecting this. So you can put all the blame on me if it doesn't work, folks. I was the one that suggested that, sometime in the first week of August, we'd be making a major high in the stock market. And frankly, I certainly could be wrong. And I'm wrong a lot, but I'm also occasionally right. But the one thing I'll do is, when I am wrong, I don't want to stand in front of the thing and get out of the way of the market, because that's something that you really can't do. Now, I do want to show one trade that I think is worthy of everybody's attention, because it's related to commodities. It's related to the rest of the markets of what we're looking at. It's forming right now as we speak. It's it's a perfect textbook pattern of the things that we look at, and that is it's the Australian dollar. This is Australian dollar versus the U.S. dollar. And if you'll take a look, if you go into Tiger TV, you're going to see a perfect harmonic pattern, as beautiful as you can possibly see, because we had a beautiful retracement to the downside on June 4th, which was the lunar eclipse and the full moon. And then now we've had a market that has rallied up to the 786 retracement. But the way that it did it is what's important, because it made it in a perfect AB equals CD format over the last month. From the early July, you've come down into the middle of July, then up into the July 19th, down into the 26th, and then rallying up into the area where we are now. That number comes in at 105.94. We're trading at 105.84. So, and it's very quiet. I mean, it's not crazy. There's no really wide-ranging bars. There's nothing to be scared of. So all the things are together there. And so, if you want to be looking to sell the Australian dollar in this area of that 105.90, this is where you'd be looking at it. You'd be risking around $500. And your first profit objective would be $2,000, because that is equivalent to what the last corrections were when we had the moves in the Australian dollar. So this is a perfectly symmetrical pattern that we're looking at in the Aussie versus the U.S. dollar, and it's related to that dollar index. But remember, the dollar index is really heavily weighted by the euro, which is 53% of it. So, we've got the euro coming in at 124.75. We've got the Australian dollar, coming in here right where it is right now. And we have a strong support in the Japanese yen versus the U.S. dollar at that 78 level. So there's a lot of things that's saying that there could be, something really dramatic happening here in the next, the next day or so. So that's what you're looking about. Now, people have asked me a question. We've had two inquiries here just recently about the S&P, whether it's a closing stop or just going above 1,400. If it goes above it, it's wrong. I mean, that's the bottom line. If the Dow goes above 13,200, that's beyond where I think it should go. And believe me, this is just a risk management tool. I mean, it might turn from that point, and if it does, you'll get back in. There'll be plenty of chances to get back in. But I don't use closing prices. I use wherever the price is trading for the high of that day. If you wait for a closing price on 1,400 in the S&P, and you have a day like you had Friday, you're cooking your goose or your duck or your pheasant, whatever it is, because that thing could close at 1423, and you don't want to sit there with a $1,100 loss when you should have been out of it at 1,400. So you've got to control your risk. It's not a question of being right or wrong in this market. It's a question of making money, and the way you make money is not to lose very much money. So you've got to pick a spot where you say, okay, this is where I'm wrong, and you just wait and get out and then go after. Hey, listen, I've been looking at this bond market since January. I've tried it 2 or 3 times to no avail, but I will get it right. The market rallied up in bonds to the 61% retracement on Friday, to that 152 level, and with the market being up today, the bonds are still rallying. So there's still a potential, for bonds to move back up there again. So that's basically what you're looking at. I do not see a big breakout here in stocks to the upside. Just looking at all the patterns that I covered earlier in the show with the small cap Russell, and looking at the NASDAQ, and looking at the utilities, and looking at the transportations, this is not what I consider getting ready for a massive breakout. What we had was a 1 or 2 day wonder coming off of that low on Thursday, and maybe it was due to the full moon, maybe it wasn't. I don't know the answer to that, because these lunar phenomena only last a few days, and they're very hard to predict. All I'm trying to do is look at the ratios first, then the patterns, and then using the timing things, and that's what I'm trying to do. Sometimes they work better than others, and they do work, and the probabilities are in your side, but they don't always work, and that's the key to what we're looking at. But if you had to put a few bucks on something right now, I would be looking at selling the Australian dollar up in this area where we are. I think it would be equivalent to be putting a $2 bet on Secretariat in the Belmont. I think this has got a probability of better than 85% winning, and a better of 4-to-1 payout on the trade if it in fact does work. If you folks are in the gold trade that we've been talking about over the past few weeks, what you want to be doing is just making sure that we stay above this 55 level in the gold market, because that's a really, really critical level to be watching. Now, when we talked about the bond market on Friday, we had that jobs report. And I believe, on Thursday we had the job report, and the Treasury bond market jumped up, quite a bit. Actually, Thursday was the Mario Draghi, I don't know how he pronounces that, where he talked about the euro, and they would do everything to support the euro. The bonds rallied all the way up to the 61% retracement at that 152 level, and then we've since gone down, made it slightly lower low. The key level in the bonds, folks, is the 147 level. That's the level that we have to look at, and the reason for that is the key support that we made a long time ago, back on the solar eclipse on June the 4th. And as long as we stay above that level, we're still in a bull market in the bonds. In other words, lower interest rates could still be coming, and we'll know more about that as we move forward into the fall. It's hard to believe that this is getting close to the middle of August already. I'm just absolutely amazed that we're really close to this level. So 147 is the key level to look into bonds. If we break below that, then I'm going to have to, revise where I want to enter, the bonds again. If you were able to sell those 152s on Thursday, you certainly don't want that to, go to a loss at that point. So those are the one things that I'm, looking at on a little bit longer term basis. So we want to keep in mind that. I've already showed the VIX index and why it's important. The SDS, I posted a chart into Tiger TV, to show that was also, completing a pretty big pattern down here. We basically went long the SDS at the 1498 level. I've moved my stop I originally had a stop in at 1298. I think you could move the stop to 1400 now, $14 a share in the thing. It's out about 26 cents from where we bought it. But I still think it has a chance, and not much of a chance. I think it's like a Cub game, where you're down 9-0 in the bottom of the ninth. But there is a chance, and it's just based on the fact that the Bradley model can have a pretty wide orb. Because remember, it's looking at actually there's 100 different cycles involved in the Bradley model, and one of them could have more importance than another, and that's why it doesn't always hit exact. Sometimes it does. Sometimes it doesn't. And if you look at the Bradley model that I put into the newsletter this week, it's the same one that I always post, but it shows that sometimes the high will be off. Even when we made the actual high, it went back and made a double top before it actually went down. So it's just basically a way of looking at positive or negative cycles. That's really what you're looking at when you're looking at the Bradley model. It's just a tool, and believe me, I have a little bit of frustration because remember what I always say about the Anthony Robbins material. All of our frustrations come from unfulfilled expectations. And frankly, on Thursday, I was really expecting the market to go down big, and yet it stopped right at the 61% retracement, and then from there it had this humongous rally. And frankly, I do not believe it had anything to do with the jobs report. If I don't know anything about reading those things, but I hear what people say about it, and frankly, it's just a number that gets changed, from one month to another. That's really all you're looking at. So we have to give it just a little bit more time. Whether that's going to be the right thing to do or not, I'm not quite sure. But I feel very strongly that we have to give it the time. That's why I mentioned in the letter when I first put it on that I thought it would be the high of the week, coming in the end of the week of August the 3rd. Here we now, August the 6th, so you got to give it a day or two. Whether it's the 10th or not, I don't think you have to wait that long, because if you're up above those numbers that we talked about, 1,400 in the S&P and 13,000 in the Dow Jones, then I would say, that we are probably, certainly wrong, and I've got at least wrong on the price part of it. Whether it will be right on the rest of it, I'm not absolutely sure. But the 786 on that S&P on the daily chart, comes in at 1396. So, that's a pretty spot on of what we were looking at for today. Okay, we've got to take a little break here, then we'll finish up the show. And 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kay Stalter, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and the stock market continues to rally. Might rally the rest of the day. We're getting close to these numbers. 1,400 in the S&P and 13,200 in the Dow. And if we get above those, it's time to put the crow on the stove with a little garlic and get ready to eat it. Well, we'll get in at another time. Now, we need to go to happier times, and we'll take a look at Newmont Mining because we've talked about the XAU, the gold-silver index, several times over the last shows. The fact that it was making these beautiful patterns, and we made a big double bottom, down in Newmont. We did that with American Barrick too, but Newmont actually was the better of the two stocks to go with from what some of the fundamental people that come into Tiger TV and talk about. I don't know the actual reasoning. The stocks look exactly the same as far as the amount of movement that we've had, but we've had a nice 8% move, off of that double bottom, which was a perfect AB equals CD pattern for the whole month of June to August. You can see that it was just about an absolute textbook in time and price. It was just nearly as perfect as you could get. It was the same thing we were looking at when we were doing the XAU, because it was also showing us that, we had a lot of these patterns coming together, and on a longer term basis, they were frankly looking at some really strong support in the XAU. When we first started talking about this, it was trading about 143, and now, we have moved up to the 155 level in the XAU, and so that's on its way now. So you certainly don't want any of those to go to a loss if you were able to to buy some of these when we were suggesting that there's a possibility that these gold and silver stocks were finally making a bottom. And we were really looking at the gold, making the higher bottoms, and then when you look at the gold stocks, they've been under so much pressure with the rest of the market up. They're very oversold, but they can move contra to what the market is doing. So that's the main thing that you want to look at. Now, I've only got a few minutes left here in the show. I want to review, what we talked about today. We've already talked about the gold. You don't want that to go below the lows we made last week if you're in the gold stocks. So you've got an 8% lead in Newmont or the XAU if you're doing that, or American Barrick. All those are moving in the same direction. I recommended here to take a look at the short side of the Australian dollar at this 105.90 level, risking no more than $500. So your stop would be like 106.40. We're very, very close to where we're going to be getting out of the SDS and the S&P if we get above those numbers in the Dow. I believe that the Bradley model is still going to be okay. It's just that my timing of putting the trade on is not right, and so I just have to move on. That Friday's day really threw a wrench into what I thought was happening because of the fact that we'd moved down so sharply from Monday through Thursday, and then all of a sudden in one day you give it all back. Now, it can work the opposite way too, but frankly to hope for that is really not a very good thing. It's better to stand aside, look for something else, and when the market does finally turn down, we're certainly going to be able to get into it because it gives you lots of chances. We already know that from gold and bonds and some of the other things that we're watching. One other thing that's very important is that we're finally getting some rain across the Midwest. The heat wave is broken, and so the grains are down a little bit. Corn is down very fractionally from the high because the crop has been hurt so bad. But you'll be surprised at what can happen to yields. I'm going to cover this on the Commodity Show on Thursday. Anyway, this is it. We've come to the end of the show. Everybody have a wonderful day. Take care of somebody who has less than you, and may God bless.